May 2021. Question number. Question number 2C. 5. So the question reads, Mark and Wanguhi are in trading partnership operating as Mawa Enterprises, ensuring profit and losses. So we are doing, this question is May CPA, May 2021, question number 5C. Question number 5C. So the question reads, Mark and, so we are, the following statement of profit or loss was prepared by the business for the year ended at 1st December 2020. So we given a summary of the income statement, which shows the net income. And then additional information. Number 1, gross sales include VAT at 14%. In addition, 10% of sales before VAT represents closing stock. The stock had been overstated by 20%. And then number 2, the amounts due to partners are to be apportioned according to profit or loss sharing ratio. And number 3, general expenses comprises partition of business premises, debt collection expenses, purchase of office stationery, cash embezzled by partner's wife, bad debts written off, business premises rent, salaries to employees. And number 4, legal expenses include acquisition of patent rights, drafting of sales agreement, negotiating sales contract, defending the business against trade dispute, mortgage interest for Mark, defending partners against wrong tax assessment, and conveyance fee for business premises, tax consultants fees. And then number 5, the purchase represents 40% of the gross sales figure of 2,736,000. The purchases had been understated by 25% and were omitted from the income statement. So required, adjusted partnership statement of profit or loss for the year ended at 1st December 2020, and the allocation of profit or loss computed in CB about for each partner. So total marks, 12 marks. So we said when you are adjusting for the taxable profit for any business, you check the details given. If the statement that you are given has a computed net loss or profit, you start with that note, the loss or profit. If the details given, they have no computation of the net profit or loss, then you start by determining the profits, and then you pick allowable expenses. So now here we're going to start with, we are going to write here the name of the business. What is the name of the business? Mawa Enterprises. So computation of taxable profit stroke loss for the period ended 31st December 2020, and then you neatly underline. So if you're using zeros, should you use, okay, you can use everything because I can see you can use shillings and zeros. So we can delete the zeros. So if they are giving you the net profit or loss, you start with that one. You start with the reported net profit. Reported net this is 994.5. Sindio? Then when they have given you, we add back disallowable deductions. So how do you get the disallowable deductions? You go right away or right to the expenses deducted for the period, and then you pick one by one. So you go to the expenses deducted for the period. The first expenditure there is general expenses. So general expenses are supposed to be allowed. But when you pick an expenditure, you also check alongside additional notes to see if there is a note that is specifically attached to that particular expenditure. So we have general expenses. We will be given the breakdown in note number 3. It includes partition of business premises. Is it allowable? Partition is not allowed. Partition is capital item. So write there partition of business premises. So remember here, we are adding disallowables only. Disallowable expenses. So you add here 64. That is a mark. And then debt collection expenses. So when you collect debt collection expenses, allowable, isn't it? That one is allowable. You don't add that one. Purchase of office stationery. That is allowable. Stationery is part of, you can't do business without stationery. Which business is this that you're doing without stationery? Lazima uandikie watu invoice, ununue kalamu. You have to buy those items, isn't it? So that one is allowable. And then cash embezzled by, cash embezzle, that is not allowed. So cash embezzle, how much is it? How much? 48. So you add back 48, isn't it? And then bad debts written off. Bad debts written off, it is allowable. A bad debt is you had sold on credit, isn't it? So that you increase your sales and you increase your revenue, increase your profit. But unfortunately, there's one of the debtors who failed to pay. So that one will be allowed. And then there is business premises rent. Of course, you have to pay rent, isn't it? And then salaries to employees. That one is allowable. So out of that total lump sum of general expenses, only 2 items were not allowed. So we are through with general expenses. We go to the next expenditure, which is legal expenses. The total value is 678, but we have been given the breakdown. So remember the procedure is you pick, you check additional information. So the legal expenses, acquisition of patent rights. Patent right is a capital item, isn't it? So legal cost, patent rights. That one is not allowable. How much is it? 24.8. That one is not allowed. Patent is a capital item. You know what is a patent? Who knows what is a patent? When you patent, what do you mean? Yes? When you come up with an idea. No one can use it without your permission. Not necessarily stealing, isn't it? If I use something, so that is to patent, isn't it? So whoever wants to use that particular idea that you're saying must pay you something, isn't it? That is a capital item. That is true. And then drafting of sales agreement. So you have legal costs that are involved in drafting a sales agreement. Allowable, disallowable? Allowable, isn't it? You make agreements so that you sell, and then you get profit so that you can give KRA something, isn't it? Ama namna gani? Negotiation of sales contract, isn't it? Allowable, disallowable? Allowable, isn't it? Drafting the business against, defending a business against trade disputes, disallowable. Legal cost, so you write here legal cost, defending trade dispute. Trade, you write here trade disputes. How much is it? 42,600, isn't it? 32 point? 42.6. This is patent. Valentine. Why is it not red? Valentine must be red, isn't it? So that is how much? 42.6. So you write here 42.6. And then mortgage interest for Mark. So legal cost, mortgage interest, isn't it? Mortgage interest. How much is it? 140. So you add that 140. That is not allowed. Defending party against wrong assessment, isn't it? Wrong assessment. How much is it? 94.6. Conveyance fees. Legal costs on conveyance. Conveyance fees are a form of tax, isn't it? Conveyance fees. How much is it? 125.8. And then we have tax consultant. We said any cost that is connected to tax is not allowed. So we write here tax consultants. Ngapi? 72.5. So tumemalizana na legal cost. We go to salaries to partners. Salaries to partners not allowed. Salaries to partners not allowed. How much is it? 450. Next is interest on capital. That one is not allowed. Interest on capital. Drawings. Drawings, how much is it? 100. So that one is not allowed. Next, commission to partners. How much is it? 1. Commission to partner, that is 180, isn't it? And then what else do you have? Interest on capital is not allowed. Interest on capital, that one is not allowed. How much is it? 250. You add back to 50. And then furniture. Purchase of furniture. How much is it? 96. You add that one. Donation to poverty commission. Donations is only allowable to charitable institutions. Donations ngapi? 64. And then construction of fire exit. That is a capital item, isn't it? Fire exit. Ngapi? 36.4. Tunaelewana? Hiyo poverty commission ndio gani hiyo? Which is this? Which commission is this? Is there such a commission in Kenya? I would say donations are only allowable to charitable institutions. We all know no charitable institution. And even if they tell you that you donate to the National Disaster Fund, unless the government has declared a disaster, So the Poverty Commission, I have never seen of that commission. Is there a commission of other kind in this Kenya? Poverty Commission, there's nothing like that. So you just confine, when it comes to donation, you only confine yourself to children's home, orphanage, and to charitable church or a mosque, or maybe Red Cross. Red Cross, you know, charitable institution inajulikana, si ndio? Sio Red Cross inajulikana. Ama inaitwaje Red Cross, eh? So this one is not allowed. Next. Yes.
So if there is donation to children's home,
that is allowed.
So it is not a must be a state approved charity.
Okay, so long as they say to children's home, that is allowed. We are through the expenses, isn't it? But there's some other information we check how they affect there. Like in additional information number one, we have been told the gross sales include VAT at 10%. So when you include VAT in your sales, what does that have? What is the implication of that? It means you have treated VAT as sales, isn't it? VAT is not your money, it is government. You only assist the government to collect VAT. So you have to submit it, to remit it. So when you include that VAT in your sales, then that one is not the position. So you need to eliminate it. So here we're going to write here sales, gross sales. Gross sales, it is how much? 27,36,000. 2736. So this one is equivalent to 114%. So we need 14. We need to know what is 14%. What is 14? So 14% will be how much? So it is 14 over 114 times 2736. So the VAT. So that is how much? 33, 36. 336, isn't it? That is the VAT in sales. So in addition, 10% of sales before VAT. So sales before VAT is going to be 2736 minus 336, which is so this 2400 is the sales before VAT. And then 10% of that one is the closing stock. So stock is going to be 10% of 2,400. How much is that? So that one will give you 200. And they have been told that this one is done what? It is overstated by 20%. So when you overstate your closing stock, what is the impact on your profit? You can just do your own assessment. Yeah, we said you take sales 10, opening stock 4, purchases 4, closing stock 2. 4 plus 4, 8, minus 2, 6, 10 minus 6, 4. So now let us overstate this one by any digit, maybe 1, isn't it? We want to see the effect here. So 4 plus 4, 8, minus 1, 7. 10 minus 7. Oh, this is 8 minus, this is 3, eh? So it will be 7, isn't it? So this one is going to be 3. Is it so? This is 4 plus 4 is 8. Oh, it is going to be 5, eh? So it's going to be, so when you overstate your closing stock, it means you have treated that overstatement as income, isn't it? So you're going to deduct it. You're going to, it's a deduction item, isn't it? So that one I hope you have understood. Now, we go to the last sentence there also. The last sentence says about what? The last sentence says the purchases represent 40% of the gross sales. So we have purchases. So purchases represents what? 40% of gross sales, which is 37 gross sales figure of 2730. So that is the figure for purchases, which is going to be 1024, 1094.4, isn't it? So that is the figure for purchases. The purchases had been understated by 25% and were omitted from there. So there's understatement of purchases by 25%. So when you understate your purchases, what effect does it have on your profit? In increased profit. So we deduct. That is a deduction item. So hizo vitu mbili zote za kudida deduct hata hiyo VAT in sales, ndio. Tumeelewana? So we go to less omitted allowable. We less here omitted allowable deductions. Allowable deductions. So we less omitted allowable deductions. So which are these deductions? The first one will be the investment allowances on furniture. So where you have not been given the block figure for investment allowances, you take, you compute for individual items. You compute for individual, we have furniture. Furniture is 10% of the cost of the furniture, which is 96. So this one is going to be 9.6. That is investment allowance. Tumeelewana? And then we also fire exit. Fire exit is also fire exit here. Fire exit in ngapi? Ni 10% hiyo. times how much? 36.4. 10% of 36.4 is how much? 3.64. You deduct that one. Any other capital item that we have? Partition of business premises. Partitions. Partition is 10% of 64, which is 6.4. Will you less those ones? And then you less non-taxable income. Non-taxable income. You less than taxable income. Yes. Yeah, we are going to learn it. It's the next topic. We say it here. When you invest in capital items includes non-current assets like buildings, motor vehicles, furnitures. So we have them. That is a topic on its own, isn't it? So when you invest in those ones, they assist you to generate income, isn't it? So you're given allowance by the government. And then at the moment, just know that furniture is 10%. That is the next topic after this one, isn't it? So you learn more, you'll understand more. So when you invest in a capital item, you're given allowance by the government so that they encourage you to do business, isn't it? They fuel your business generation activity, isn't it? The government wants productive people. Productive so that you give them tax. You see, they are complaining everywhere. They want tax. They want tax. Tax only comes when you are productive, isn't it? So if you're not productive, you are not useful to government. So you need to be productive. So they're giving you allowance to produce. Nanielewa? So we are going to learn about investment allowance. When you talk about capital items are non-current assets that assist you to generate more revenue. So, like the chair you're sitting on is a capital item to this school, isn't it? Because you'll sit on, there's another student who will come in and sit on the chair. And when he sits on that chair, what is the impact to the school? School fees. And that is revenue, isn't it? Without chair, students will not say you complain. It can even go away, isn't it? So that chair is a capital item to the school. Ama, not this one. This one is not a capital item, isn't it? Yeah. So non-taxable income. We check non-taxable income. So we go to the income section. The income, the first one is unrealized foreign exchange gain. We say that one is non-taxable. Unrealized foreign exchange gain, which is 16, isn't it? So you deduct that one. Insurance recovery on stolen goods, that is taxable. Over provision for bad debts is not over provision for bad debts. That one is not 34. You deduct. And then dividend from, and then that one, interest on drawings. Interest on drawings is non-taxable income. How much is it? 45. And then VAT in sales. VAT in sales, how much? It was 336. Tunaelewana? VAT, and then we have overstated. Is it overstated? So overstated stock, overstated closing stock, overstated closing stock, which is, so this closing stock, it was how much? 240. 240 is equivalent to 120, isn't it? It's overstated by 20%, is it so? So it's going to be 20 over 120 times 240. So what do you get? 40. And then we have understated purchases. Understated purchases. So the purchases, this one, they said it is understated by how much? By 25. So this one is equivalent to 75. So we say it is 25 over 75 times 1094.4. This 1094 is equivalent to 75%, isn't it? It is understated by 25%, isn't it? So now we are interested in knowing 25%. So how much you get? Unapata ngapi? $264. 364.8. And then we less income from specified sources. Income from specified sources. Income from specified sources. Income from specified sources. What do we mean? These are taxable income that should not be combined together with business income. So we have dividend from Haki Cooperative. So you less dividend. Dividend, how much is it? 42.5. And then we have another one is that one is, isn't it? And then now you get the adjusted taxable profit or loss. Adjusted taxable profit stroke loss. Adjusted taxable profit stroke loss. Can we do the computation there? Yes.
Last statement, income from sales. You have said it is taxable income that should not
It should not be combined. This is what you are computing here is business income. So we have 5 sources of income in Kenya that are taxed. We say number 1 is employment. Number 2 is business. Number 3 is rental. Number 4, investment. And number 5, farming. Those are the 5. So you should not combine them together. Each and every source should be indicated separately, isn't it? So when you receive dividend, which kind of income is that? When you receive dividend, hiyo ni income gani? Investment. Sasa unaona amecombine na business, ameweka kwa business income, si ndio? Unaitoa kwanza alafu utaionyesha peke yake. Serikali inataka uoneshe wewe, mimi nilipata hii kwa farming. Alafu hii nilipata kwa biashara. Unaelewa? So kila kitu unaonyesha kando. Sio ndio sawa ama? Haya. Unajua sasa watu wengine naona this is the procedure of doing these things. It is very easy. This is a question you can even do when your eyes closed. And you get all the Sasa tax hakunanga mtu anaanguka hapa. Because hii swali itakuwa kama hii next sitting. Hiyo ndio exam unaenda tu kama umerelax. Kama unakuwa na tension kwa exam, so usikuwe na tension. So unajua ile kitu inakaa. Kuna watu wengine wanakuwa na butterflies. Wanakuwa na butterflies. Mkono inakataa kuandika. So can we do that adjustments? And then here we come here and have the allocation schedule here. Partners distribution schedule. Distribution schedule. First of all, do the adjustments. Nani aelewi kitu tunafanya? Fanya okay, unataka kuandika ama ku add? Kuandika. Zote mbili, andika. But before uandike, wacha tuandike hiyo distribution schedule. So ni partners wangapi? Wawili. Nani na nani? Mark na so M na W, alafu hapa unaandika total. So here you give them when it comes to distribution schedule, you are distributing the gains from the partnership business. What are the gains when you are in a partnership business? If they are giving you salary, that's a gain. That is what you list there. If you have any bonus or commission, that is a gain. Interest on capital, that is a gain. Those are the gains. So you list there one by one. So we check those. So we have the interest on capital or salaries. We start with their salaries they got from the partnership. So the salaries are there. What is the salary? Partner salary, the amount was 450. Is it so? The total amount is 450. So how do you subdivide this to 50? If they're not given you the proportion of division, you divide according to their profit sharing. So you give Mark 2 out of 5. 2 out of 5 times 450. So that one is how much? 180. So you give them 180, and the other one 70. 270. And then we have interest on capital. Interest on capital. That is the second item. The total interest on capital it was 250. You share. Mark unampatia ngapi? Unampatia 100. Na huyo mwingine 150 total. Do they have commissions? Commissions to partners. You write their commissions. You share. The total is 180. This is 70, 72. The other one, 108. And then you less interest on drawings. Interest on, not drawings. There's a difference between interest on drawings and interest on drawings. You less interest on drawings. Interest on drawings, 45. So to 45. So you less that one. Nakuja ngapi? You put it in bracket. This is 18. This other one, 27. So you less that one. And then here you say share of profit or loss. Share of profit stroke loss. You leave some space there. Then you write adjusted profit. Adjusted profit stroke loss. So the figure that you will get here, this figure that you'll get here, you're going to write here. After you've computed this one, I hope somebody had done this. You write here. Unaona hiyo figure. You subtract this, and you add this. If the figure that you get here is positive, you share this as profit. Sijui kama tunaelewana. Una share kama profit. Alafu na add other incomes. Other incomes sasa ndio hii. Unaona hiyo? Hiyo other incomes una share. Andikeni haraka haraka. Andika. So that is how we do for partnership. So we want to start a new one, taxation of companies. Taxation of companies. And the first question I'm going to look at is taxation of companies. So you open May 2019 question number 4. May 2019 question number 4. May 2019 question number 4, taxation of companies. So companies, taxation of companies. And the question you're doing is May 20, CPA May 2019, CPA May 2019, question number 4. Question 4A. May 2019, question number 4A. So we read the Parato Limited has provided the following income statement for the year ended 31st December 2018. So we've been given the income statement. In the breakdown, we have dividends, comprises dividend from Beta Limited, that is additional information number 1. And then dividend from Bona Cooperative Society. Number 2, foreign exchange gain comprises amount of realized foreign exchange gain, amount of unrealized foreign exchange gain. Number 3, bad debts recovery related to bad debts on sale of furniture, bad debts on credit sale of goods. And then number 4, insurance claim related to insurance compensation on loss of profit, insurance claim on loss of motor vehicle. Number 5, advertising. Advertising comprises advertising through daily newspaper, advertising on passenger shades at bus stops. And number 6, subscription related to annual subscription fee to Chamber of Commerce and Industry, subscription to employees sports club. Number 7, interest comprises interest on debentures, interest on loan acquired to build commercial rental houses, and interest on money borrowed to pay tax and penalties. Number 8, legal costs comprise appeal to tax tribunal, defending business property rights, registration of a lease agreement, in bracket 100 years. Capital allowances were agreed with the Commission of Revenue Authority at 960. So they want you to adjust the taxable income or loss for Parato Limited. So this is a company. So you follow the similar procedure. You check whether they have already computed the net loss or profit for you. So you write the name of the company, Parato Limited. Pareto Limited, computation of taxable income, computation of taxable income, taxable income for the year of income, or for the year ended, for the year ended 31st December 2018, and then you underline. So you write here shillings and thousands if you're doing in thousands. So you start with the reported profit, or loss. If it's a loss, you put in bracket. It is 758, 7584. So you write there 7584. Then you add back disallowable expenses. Add back disallowable deductions. You add back disallowable deduction. So you go to, you pick an expenditure, you check alongside the additional notes. So the first one is salaries and wages is allowable. Do you have any notes affecting salaries and wages? Nothing. So you don't leave it. Increase in provision for bad and doubtful dates. So that is general. So increase in provision for bad and doubtful dates. If they have not mentioned increase in provision for bad dates, specific, if it was specific, then to be allowed. So these are general. How do you distinguish between general and specific? Specific, it will have the word specific. General is silent the way this one is silent. So how much is it? 1, you add it back. It was deducted and it's not allowed to be deducted. So you add it back. And then number next is contribution to NSSF. So if you contribute to NSSF on behalf of your employees as a company, that particular expenditure is allowed. So that one you leave it. And then advertising. Advertising is supposed to be allowed, but there is a note that is affecting advertising. So you check the notes. Note number 5, it says advertising comprises advertising through the daily newspaper. That one is allowed. And then advertising on passengers bus. So that one is not allowed. So right there, advertising on passenger sheds at bus stops. So that is called advertising of capital in nature. It's not allowed. So you add there, how much is it? 430. So out of the total cost, 430 is not allowed. You add back. You're through with the advertising. You go to the next item, stationery. Stationery is allowed unless there is a note. There's no note affecting stationery. And then the next one is depreciation. Depreciation is not allowed. Depreciation is not allowed. How much is it? 200. So you add 280. Subscription is supposed to be allowed if it is meant to trade association. So we have been given the breakdown of subscription. Number 6, annual subscription fees to Chamber of Commerce and Industry, that one is allowed. Subscription to Employee Sports Club, not allowed. Subscriptions to employees sports club. Is it sports club? Sports club. That one is not allowed. How much is it? 610. So you add that one. That one is not allowed. You go to the next item, which is trade laws. A trade laws means that in the last trading period, you had a loss. So in the current period, it will be allowed. So that one is allowable item. And then we have interest. You go to the interest. In note number 7, they're telling you interest comprises interest on debentures. A debentures a loan to the company. That one is allowed. A debentures a loan to the company. So the interest thereon is allowable. Interest on loan acquired to build commercial rental houses. That is an interest on loan, commercial rental houses. Interest on loan, commercial rental houses. That one is not allowed. Commercial rental houses. How much is it? 110. Then interest on money borrowed, to pay tax. You don't borrow to pay tax. Tax you pay on the profit you gain. That is 70. So you add 70. Tumeelewana? And then we have transport. Transport is allowable unless there's a note attached to it. There's none. And then there's legal cost. Legal cost, we have note number 8. Appeal to tax, legal cost. So right here, legal appeal to tax tribunal. How much is it? 150, 155. And then defending a business property right. Business property Defending a business property right. Property right, that is capital. How much is it? 120. And then registration of a lease agreement. Lease agreement. Lease agreement should be less than 100 years. It should be 99 years maximum. Should be 99 years maximum. So you add that to the 90. So we have through the expenses. We are through the expenses. And then now we come here less, omitted allowable deductions. Omitted allowable deductions. You less omitted allowable deductions. So we less omitted allowable deductions. So the first deduction is note number capital allowances. Note number 9, capital allowances. So you write there capital allowances, that one is allowable, it's omitted. How do I know that it's omitted? It is not among the other expenses. So it is not listed among the other expenses, therefore it was not deducted. So that is 960. So that one you deduct. Are you seeing how we are clearing the notes one by one? So far we have cleared number 6, we have cleared number 8, we have cleared number 7, we have cleared number 6, we have cleared number 5. Are you seeing? And then we less non-taxable income. Non-taxable incomes. So non-taxable income, we go to the incomes for the period. So the first income is a gross profit. That one is taxable. And then we have dividends. That one is income from specified sources. We go to foreign exchange gain. Foreign exchange gain breakdown is given there. Foreign exchange gain comprises amount of unrealized foreign exchange. So the total foreign exchange gain, it is how much? 175. This 175 comprises of the realized, which is 125, and unrealized fee to make 175, isn't it? So we are saying this one is not taxable. So right there, unrealized foreign exchange gain, which is 50. That one is not taxable. Sijui kama tunaelewana. Wameiweka yote. So they have already included everything there. Everything that they are including in the incomes, to them, it means that they are supposed to be taxed. So we are identifying those ones that are not supposed to be taxed. So all the incomes there are indicated. So we're going through one by one, analyzing those ones that are not supposed to be taxed. And then rent received, that is income, that is specified source. Interest, that is specified source. And then bad debts recovered. Bad debts recovered is supposed to be taxable income, but if it relates to revenue items or credit sales. So bad debts recovered on sale of furniture. Bad debt, sale of furniture. Here hyperbolic. How much is it? 1. That one is not taxable. So you deduct that one. You go to the next item, insurance claim. Insurance claim, you have been given the breakdown. Insurance claim related to insurance compensation on loss of profit, taxable. Insurance claim on loss of motor vehicle. Insurance claim, motor vehicle. How much is it? 4.5. So 4.5. And then profit on sale of equipment is non-taxable. Profit on sale of equipment, ngapi? 88. And then sale of debenture, that is non-taxable. Debenture is a loan. So when you acquire a loan, that is not an income taxable. So 4,200, you deduct that one. And then you less income from specified sources. So you deduct what you don't go to the additional notes. Here you deduct what they added. So you deduct the dividend. Whatever it is that they added is what you deduct. Dividend was how much? 675. So you deduct that one. And then we have rent. Rent, how much is it? 580. You deduct that one. And then interest income, you deduct this one. Interest income, how much is it? 289. And then here you get what you call the adjusted taxable profit. Adjusted taxable profit stroke loss. So but at that point, ukiangalia additional information, tumedeal na, we are still remaining with number one only. But we have finished number 2, number 3, number 4, number 5, number 6, number 7, all the way to number 9. So when you pick an item is when you check the additional information and then you adjust accordingly. So can you do that adjustments? Yes. At one? No, you deduct the entire amount first. Then now you come and see the one that is supposed to be taxed. Hii waliongeza hii. I know what you are, 175. Unatoa hii yote ile wali-add yote kwanza. Unanielewa? So zile utakuja u-add other incomes hapa, ndio utakuja sasa uangalie gani inataksiwa na gani haitaksi. Unanielewa? So the entire amount that they recognize as dividend income for that period, you deduct the entire amount. Now when it comes to treating it treating it on its own, is when now you analyze which portion of the dividend that is supposed to be taxed. But in the meantime, for the purpose of determining the taxable income for the company, so you see they included 675 in the incomes, isn't it? 675. Yes, that is what you deduct. Wewe unataka tu deduct gani? Sasa kwa hiyo nini breakdown, tutakuja hapo kwa breakdown. Sasa zile tuna analyze dividend on its own. So this item that I've listed here, they're supposed to be taxed on their own, isn't it? But whatever it is that they added to the business income is what you deduct first. Now, when it comes to determining what is taxed on their own, is when we analyze them. Okay? Can we do that one? 8217. 2217, isn't it? That is taxable income, adjusted taxable profit. And then now, if there are other income, now you add your other incomes. Tunaelewana? Other incomes. So we go to was there the interest income also? No, we didn't have interest income. So we go to they had interest income, isn't it? So now we start with the dividend, this one that this guy is talking about. So we start with this dividend. So we go to the note of the dividend. So we want to know of the dividend which is taxed. So we have dividend from Beta Limited. We said if you receive dividend from other companies, the withholding tax is final. Dividend from Bona Cooperative. So we're being told it is net. Is it net? It is net. So dividend Bona Cooperative from cooperative, this one is the one that we add. Ile imetoka cooperative. So we determine the gross amount. It is net. Net meaning there's withholding tax. You see, dividend is comprised of 2 items. Dividend from Beta Limited, which is 505. This one we are saying withholding tax is final. And the other one is 170. This one we're going to gross it. So we're going to say 100 over 85 times 170. We're going to determine the gross amount. Nani haelewi ile kitu tunasema hapa? Nirudie. So unaona if you add 505 plus 170, what do you get? You get 675, isn't it? But out of this 675, 505, they have already paid tax, so you don't need to include it here again. Are we communicating? Yeah, that is how we treat it. So now what do you get? 200. So you add here 200. And then we have, from dividend, we have rent. So you're going to add here rent. The total amount is how much for rent? 580, isn't it? You're going to deduct, that is 580. Is it millions? 1,000, isn't it? So going to deduct the, you're going to deduct 110. This is the interest on the commercial rental property. How much will you get? Eh? 170 for 70. And then we have interest. Interest for individuals with the holding tax is final, but for companies with the holding tax is not final. Interest income. So we have interest from Bahari, net. So interest, we're going to determine the gross amount. It attracts with the holding tax of 15%. So you're going to be 800 over 85 times 289. How much will that be? 340. 340. So those are the others. So you see, you need to indicate them separately. You need to show them separately. Apart, you don't need to combine them together with the business income. So you get their total taxable income. Total taxable income. Now for companies, it's 30% of the total taxable income. That is the tax liability. So add these three items. What do you get? How much you get? 32, 32.27. So the tax will be tax liability. In case you had been asked about tax liability, it will be 30% of 32.27. That one will be the tax liability. So that is how we do questions on companies where tumeelewana. So hiyo tumemaliza, hiyo ni 10 marks. So by the way, the question just wanted us to reach at this point, but I've gone all the way. So you can write it and then we do another one. Sawa. You share it amongst you to go on a dividend up. So sorry? Interest ndio dividends. Kuna dividend two kinds of dividends. We have qualifying dividend. Si kama hii una add hiyo una share na our partners. Una gross alafu una share. Hii ni taxable tena. Una share unapatia partners. Si imekuwa kwa hiyo swali tulifanya. Dividend kama iko una gross alafu una share. Kama kuna dividend from cooperative society, una gross kwanza alafu una share. For partnership business. For partnership business. Haya, utanisainia hiyo, utaandika hapo date. Tunaelewana? You have a question? So tomorrow we'll do more other questions. But at your own free time, keep on trying these questions. So at your own free time, you can attempt. There is a question on partnership. There's a question on partnership. May 2019, question number 5C, partnership. May 2019, question number 5C, attempt. May 2019, question number 5C. So tomorrow we shall be doing more questions on companies. So before I give you more assignments, so you attempt this one. Attempt that one. May 2019, question number 5C. Tunaelewana? Tutaniletea hiyo.